All right, this is just going to be a short video on expectations in trading, just in general. We're going to talk about the expectations for a trade and expectations for a trading day and the effects that those have on your emotions before a trade, your emotions after a trade, and the long-term effects on your trading. So I'll start with expecting to make money from a trade. Trading day. Let's start with trading day. If you expect to make money from a trading day and then you go and you take a loss, what's going to happen is that deviation from your expectation to reality is going to cause way more emotion than if you were expecting nothing. It's thinking, oh, I'm going to make money, and then you actually end up losing money that is going to make you really upset, and it's going to make you more likely to revenge trade. It's going to make you more likely to just full port, maybe oversize, just blow your account. There's nothing positive about it. Now, that's just what happens after a trade. But before you even take a trade, if you're expecting profit on the trading day, you're going to be looking for way more setups. You're not going to be sitting there waiting and reacting to the market. Instead, you're going to be trying to, force trades, trying to meet your own expectation of profit, rather than just looking at it objectively, thinking this is what's likely to happen, so I'm going to take a trade that aligns with what is likely to happen, and then expect nothing from that trade. If you expect a loss on the trading day, you're going to be very fearful the whole day. You're going to probably take less trades. Even if something aligns with your strategy, you might just not take it at all because you're expecting to lose money if you trade. And then if you do take a trade, you're a lot more likely to take profit early. You're a lot more likely to exit the trade at a point that is not optimal because you're afraid that if you don't, you're going to end up losing money. And that's just going to ruin your statistics. It's going to ruin your risk to reward ratio, or whatever you track. It's going to ruin your statistics. You're going to cut winners early, and then you're also more likely to take losses because maybe you usually have a stop loss of 10 points, and then it goes down to 5 points, and you're like, well, I don't want to lose 10 points of profit, so I'm just going to close at 5 points, and then it ends up actually hitting your take profit. And your 10-point stop loss was there for a reason. It's there because it works, and it works because of your data and your testing that you've done. But instead of keeping that and trusting it, you're going to be more likely to cut it at 5 points because you're afraid and you're expecting to lose money on the day. Now, those are the expectations for the trading day. For a specific trade, if you expect to make money on a trade, then if the trade starts going against you, you might be more likely to get emotional about that. You're going to be thinking, why is this happening? You're going to be more confused. You're going to be more upset about it. So maybe that'll also mean that you'll close the trade early. Maybe that'll mean that you hold it for too long and it goes back to your stop loss. Like maybe your TP is usually 50 points, but you're thinking, wow, I'm expecting a lot of money from this, so I'm going to put this at 100 points. And then it ends up hitting your original 50-point take profit and then goes straight back to your stop loss, and then you end up losing money. So that could happen during the trade if you expect to make money. And then also there's the same thing as with the trading, expecting profit from a trading day, but with just a trade, is that after the trade, you're going to be a lot more likely to get upset about the trade. If you lose a trade, you're going to be a lot more likely to revenge trade after that. And it just causes more emotion. Now, if you go in expecting to lose a trade, it's pretty much the same thing as losing a trading day. You're going to be more likely to cut profits early. You're going to be more likely to cut the trade when it hasn't hit your stop loss yet. And then after the trade, if you do end up losing, it's just going to confirm what you were thinking. It's going to make you think for the next trade that you were right to be fearful, which is just going to cause more of the behaviors that I just talked about, like cutting the trade early. Um, and if you win the trade, that might actually be bad for you because that might make you overconfident in the next trade. That might make you more emotional, more happy about the win, which is going to cause overconfidence, which will then cause overtrading. It'll just flip right on you. So the optimal thing to do is to have a narrative which is separate from your expectations for profit. So you want a narrative for what price has done, what price is going to do, but that doesn't mean that you should have expectations for making money. Like you have an expectation for what price is likely to do based on your strategy, but you don't have an expectation for how much money you're going to make from that. It's just like, all right, I'm going to enter the trade. If it works out, it works out. If it doesn't work out, it doesn't work out. I don't actually know what's going to happen. I don't have expectations. And that's going to cause much less emotion. It's also going to cause you to enter way better trades in the first place. So that is the optimal way to do it. You want to have no expectations going into the trading day, no expectations going into each trade, and don't let your wins, don't let your losses affect your expectations for the next trading day or next trade.